Today, we're going to talk about a corner of the Indian market that, maybe doesn't get all the flashy headlines. We're talking about the giant state-owned fertilizer companies, the PSUs. And this is an investment story that's less about shooting for the moon and more about something that's actually pretty hard to find these days: stability. So let's just get this out of the way right up front. If you're here hoping to find the next multi-bagger, that stock that's going to go up 10 times in a year, well, this probably isn't the story for you. We're not talking about rocket ships today. No. Instead, we're dropping anchor. This is a story about something much more grounded, something much more predictable. We're talking about strategic stability. And to really get why these companies are so stable, you first have to understand the sheer scale we're dealing with. And it all kicks off with one absolutely critical resource: natural gas. Okay, let's start with just one number, a really big one: 28.4%. Just kind of let that number sit there for a second. It is the absolute key to understanding this entire industry. So, what in the world does it represent? That is the fertilizer sector's slice of India's entire natural gas consumption. Just think about that for a second. Of all the gas used for everything, power plants, factories, cars, you name it, nearly a third of it goes into making fertilizer. This isn't just a business, it's a foundational piece of the entire national energy grid. And here's the thing. This demand isn't optional. It's what economists call non-discretionary. See, gas is the main ingredient for making urea, which is a key fertilizer. Farmers need that fertilizer to grow our food. So these companies have a built-in customer base that's incredibly stable, year in and year out. It's not a choice, it's a necessity. And here's why that demand is so incredibly predictable. India is already about 80% self-sufficient when it comes to producing urea. Now, what does that mean for an investor? It means you're not betting on some risky future expansion project. The demand is already there. From the plants that are running right now, their need for gas is locked in. So let's boil it all down. The big takeaway for an investor is this: the main risk isn't about, finding someone to buy the product. That part is rock solid. The real challenge, the whole game, is managing the cost of your inputs. And that means managing that huge need for natural gas. Right. And that leads us perfectly into the second major piece of this puzzle: the role of the government. You simply cannot understand these companies without understanding the policies that shape their entire world. Now, to get a handle on the risk, you have to look at this big shift that happened back around 2015. See, before then, these fertilizer companies got first dibs on cheaper, domestically produced gas. But after 2015, the rules changed, and they were forced to start buying a lot more of their gas from the much more volatile global market. And that creates this fundamental trade-off. Domestic gas, it's cheap, it's stable, but there just isn't enough of it. So to make up the difference, they have to import what's called RLNG. That's regasified, liquefied natural gas. And relying on that exposes them to the wild, chaotic price swings of the global energy markets. So the obvious question any investor would ask is, wait a minute, doesn't being exposed to all that global price chaos mean a much higher risk to their bottom line? And the answer is yes, it absolutely does. But, and this is a huge but, there's a massive buffer in place. The government subsidy system is specifically designed to act as a shock absorber for exactly this kind of problem. So here's how it works in a nutshell. When global gas prices shoot up, the cost for the PSU to make fertilizer also goes up. But the price that farmers pay for that fertilizer is fixed by the government. They do this to keep food prices stable. So to fill that gap, the government steps in and pays the company the difference through a subsidy. So what's the big investor takeaway here? It's that while there is absolutely margin volatility because of those global prices, the downside risk, the risk of losing money, is seriously cushioned by government policy. This safety net isn't just a nice little perk. It is a core feature of the entire business model. Okay, so if demand is basically fixed and profits are cushioned by the government, what actually makes these stocks move? Let's get into the key things an investor really needs to keep an eye on. I mean, it's the most important question, right? If the basics are so stable, what's left to drive the stock price?
Well, there are really four big things. First, you still have to watch global gas prices because they determine just how big that subsidy from the government is going to be. Second, and this is so important, is the timing of those subsidy payments. If the government is late, it really squeezes the company's cash. And the last two are all about how well the company is run. Things like energy efficiency, making small tweaks to use less gas, that flows right to the bottom line. And finally, working capital discipline, which is really just a fancy way of saying smart cash management.
So you see, your whole perspective as an investor has to shift. You stop worrying so much about sales volumes and you start focusing on the government's financial health and how quickly it pays its bills. It becomes less about market risk and much more about credit risk and the timing of cash flow. All right, let's pull all of this together. What is the complete bottom line investment case for these fertilizer PSUs? This table really sums it all up beautifully. Let's just walk through it. Demand risk, very low. Policy support from the government, super high. Volume growth, it's flat, which means it's stable, not some wild growth story. Margin volatility, yeah, it's there, but it's buffered by policy. And the big one, its strategic importance to the country is off the charts. Here's probably the best analogy to help you wrap your head around it. Don't think of these companies like a high-flying tech stock. Think of them more like a regulated utility, like your local power company. They provide an essential service, their prices are regulated, and they offer predictability instead of explosive growth.
And if you want to boil it all down to one single idea, it's this. Fertilizer PSUs are not growth stocks. They are policy-anchored cash flow visibility plays. The whole point isn't about massive expansion. It's about having a clear, stable, predictable view of their cash flows, all backed up by national policy.
So, I'll leave you with this final thought to chew on. In a world that seems to be getting more volatile and more uncertain by the day, could this kind of strategic, policy-backed stability actually be one of the most valuable assets you can have in your portfolio? Something to think about.